Good afternoon. This is Ken Long from Tortoise Capital Management with a review of the weekly trading plan for July 28th, 2012. Start off with the weekly report and then move to the daily. We're in a bullish normal market condition. On an annual basis, using weekly RSI 14, we're at 60 out of 100, moving towards the higher end of neutral. 10-day NDX with the breakout on Friday, we're at 110, coded in the green. Percent stretch above the 200-day moving average is coded white, bullish at 5.86%. The slope of the 50-day moving average has improved to positive 0.27%, coded white, bullish. ADX 14 remains weak at 14.5, but now the bulls are in charge. ATR percentage at 1.36 is still rated as normal. So we're in a bull normal market in overbought conditions. The blended monthly rebalancing, current holdings, Treasuries, emerging market bonds, U.S. real estate, and the 13 ETF portfolio, Treasuries, U.S. real estate, and the Dow Industrials. Next reevaluation on or about 1 August, and I'll show you on the next slide what those holdings would be if we ran it today. Theoretical exposures at 90% in ETF2. Model portfolio will be exposed at 90% based on adding 4 new positions on Monday with biotechs, home builders, real estate REITs, and dividend leaders. The 13 and 26 ETF portfolios. In the 13s, it's Treasuries, real estate, and SPY. In the 26 ETF, it's Treasuries, agriculture, and emerging market bonds. Market health check. The vertical blue lines represent 10, 20, and 30 days of look back. The horizontal purple lines represent resistance levels. We just breached one on Friday at 138, which is really key since it's tested that 3 times and now finally broke through to close higher. Horizontal red lines represent important support levels that have held in the past. You can see the one at 133 held, which was at the bottom of the regression channel, which is formed by the 30-period regression line in the center black line, and then the outer black lines are the regression channel formed by the maximum excursion from the regression line during the look-back period, which happened in late June. So we got a pretty regular looking channel right here. And this last trade that we highlighted on Wednesday to be alert went from 133 to 139 within the boundaries of that channel. The blue parallel lines are an extension of the regression line going forward. You can see the swing high that we had in the last 12 months was at 142 way back in March. A 5% pullback from that is at 135. A 10% would be at about 128.5. So we're in the upper band of noise. Pullbacks from the swing high of 0 to 5% are considered noise. So we've walked our way off the 200-period moving average. It's been a slow grind, but we're now getting ready to go up and test 142. A breakout above 142 will be significant if it can hold, because that will have cleared the last 12 months worth of price action, new 12-month high. That will be universally seen as a positive thing. You can see the 200-period moving average in the shaded area underneath it, marching forward, and how the river, which is the 30-period Bollinger Band plus or minus 1, came down, tested, and now the river itself is rolling up, and the 200-period moving average rolls on relentlessly. Percent price oscillator has closed its negative move, and now the jaws are getting ready to open. We've moved into overbought conditions on Williams percent R. On ATR, you can see that we are still under 15, which is very positive for the potential for a continuation of the trend. And the bulls just took charge, so now we are well postured technically to make a nice run. And then in retrospect, this would be seen as the 200-period moving average holding as support in the beginning of a base with an upward bias. So this looks very favorable for the upside, again, if we can get through 142. Failure at 142 You can see the targets here would be the regression channel at 137, 5% pullback at 135, regression channel around 133, and then 131, 129, 127 to go back to previous support resistance levels. 131 would be the key one at 200 period moving average. So I actually probably more downside risk than upside right now. But again, if we get above 142, watch the market explode. ETF2 regional report, 9 of the 10 indexes are on a buy signal compared to their 4-month moving average filter, and that brings us to 90% invested, 10% cash looking forward. SPY at 54, still better than EFA at 43. Inside the U.S., it's the large caps, then tech, then small caps, then mid caps. So starting to get a little more of a risk on flavor here. 2 strongest sectors, SPY, the large caps, and technology, the 2 weakest, Latin America and Japan. World market model. Only the large caps and selected small caps in the U.S. are now above average. The mid caps and small caps generally are lagging. Treasuries, corporate bonds, and real estates continue to do well. Gold, silver, oil, and commodities are lagging. Japan is lagging, but Asia less Japan has improved on strength in Singapore, Malaysia, Australia. China continues to be an exceptional laggard in Asia. Western Hemisphere, Mexico leading the way, Brazil dragging, Latin American emerging markets both weak, all of Europe weak. Inside the business sectors, it's the defensive plays, staples, utilities, healthcare, and that's both in the U.S. and in global. Top 30 ETFs based on the average score of strength, consistency, and volatility. The winners continue to win. It's biotechs, home construction, real estate REITs, emerging market debt, dividend leaders. Those are the positions that we add. Biotech, and we will choose a second position in IBB just because it has more volume than the S&P biotech holder ETF. So we'll add home construction, biotech, REITs, and then we'll skip the bonds and get down here to Morningstar Dividend Leaders Index, FDL. The Dow 30 based on the same lens, only this time we've sorted it by strength. It's the XLPs of the world: Walmart, AT&T, Merck, Disney, Verizon, Coke, Home Depot, GE, Johnson & Pfizer. It's the producers still at the bottom though: Hewlett-Packard, Cisco, Caterpillar, Alcoa. And then you see a ton of the financials: JP Morgan, Bank of America. I continue to think McDonald's is urging us to look at it as a value play. ETF trading instruments by volatility. A new chart, regression line crossover in the river. The regression line 10 is in thick blue. The regression line 30 is in black. The river is formed by the 30-period Bollinger Band, plus or minus 1 standard deviation. Those are the thin lines forming the channel. The red line is the 30-period moving average. That's also the Bollinger Band mean. You can see right here that SPY has turned the corner. The river is pointing up. Price has been hovering on the upper boundary of the river, and the 30-period is outside of the river. So again, we're postured for positive move. When both regression lines are outside of the river, pointing in the same direction, you have trending behavior. You can see it very clearly here in treasuries, even with the little bit they gave back on Friday. Gold in a generally downward posture, but it has found support at 150. And if we saw weakness in SPY and the small caps, gold could be postured here for a resumption to 175. Strong base at 150. It's again, it's a playing defense, and you can see how the downtrend has started to flatten out here with the Bollinger Band mean coming into sideways quiet channel. Market volatility study. It has been creeping slowly upward, but this has now become the new normal. So we are back to historical normal tendencies here at using a measure of 30-day standard deviation. We'll continue now with the daily report for July 29th. Gap statistics over the last 30 days. 13 times in the last 30, the market has gapped down. 5 of those 13 times, the gap down has continued to fail for an additional minus 0.21. 8 out of 13 times, the gap down has reversed to close higher for a positive 0.46 follow through. 17 times, the market has gapped up. 6 of those 17 times, about 1/3. The gap up has reversed to close lower for a follow-through of minus 0.84. The gap ups that continued to gain and go higher, 11 times out of 17, additional follow-through of 0.5. So the gap ups have been the more volatile and better trading plays. Standard deviation of the gap for SPY continues at 0.75%. You can see the time series on SPY with us now well into overbought conditions. In the overreaction system, there's a short signal on EEM emerging markets, no signals in channeling. You can see the pivot points and the 10-day min pain and max pain. These are the ones that have gained or lost the most with respect to their 10-day high. Losers have been VIX, natural gas, oil, and oil exploration. And 10-day max pain among the Dow 30 has been Bank of America, Cisco, Hewlett Packard, McDonald's, and Microsoft. See how the volatility has pulled back to normal, but slowly increased here this past week. ADX remains low, but with bulls in charge. No pattern trades per se. However, a number of auto framer symbols, including some favorites like Cliff Natural Resources, the VIX, McDonald's, Verizon, and Cisco, all test out at better than 2-to-1 on a mechanical entry with a test of the 10-day high as the profit target. Dow Tactical Summary, only 2 dojis, McDonald's and Boeing. You see the top 5 max pain range compression with 3 testing out well in the auto framer, McDonald's, Cisco, and Verizon. So McDonald's should be very interesting. It was a percent loser on Friday on the big up day. It was the laggard. ETF 30, only 2 dojis in gold and natural gas. No patterns for the swing traders. VIX tests out at 3.5-to-1 on the auto framer and then leads the way with the max pain range compression, VIX, Japan, Treasuries, coal, and U.S. real estate. Market mosaic, you can see the 30-period regression line and the big breakout on Friday to close higher than the 3 previous swing highs. You see how nice and clean that regression channel was. This is the regression channel that alerted us on Wednesday to be ready for a rebound and a test of the upper channel, which is exactly what happened the next 2 days. Not predicting, just saying that would be absolutely normal behavior for price action in that kind of a channel. You can see that nice move Friday has made the slope of the regression line come back up to equal its 10-period moving average. That is a very favorable sign that it didn't dip below the average of the last 180 days and that it's still positive. And you can see that after a 1, 2, 3 standard deviation move up, this little pullback has now apparently come to an end, description-wise. And we've been hovering right around 5% above the 200-period moving average. That looks like a sideways channeling, but with a slightly upward tilt. And we're got a 5% cushion to the 200-period moving average, which is the dotted red line. So this is well postured as a support base for the next leg up. The argument for that is that the U.S. rather than the world right now a little more stable, so it's the looking on a relative basis to be a better place for money to be treated if you're looking for growth. And right now, it's the large caps are getting it done. And inside the large caps, it is the consumer staples and dividend payers. That's the trade. Z-scores of the regression line slopes, you can see that the 90 period has tilted and starting to roll up. It has a long room to run if we really have found support in this move, and it looks like we have. You can see prices now working the upper Bollinger Band in the river, and in long periods of bullish moves, That's what it does. Yes, it's been a little bit more volatile, but then that comes after a full 10% pullback when the market shock was pretty significant. This is grinding up behavior, and you can see if that volatility declines, that upward move can make a nice play, and it has to get above this right here, about 142, to test the highs from last March, and then it will be smooth sailing. And this will look in retrospect like an obvious buy on dip opportunity. The width of the Bollinger Band channel, the river, narrow at the lower end of normal compared to the last 10 years. So that's actually a good thing. That's a quiet volatility. And then you can see the Z-score of the 30-day price and its own 10-day moving average. It's at an extreme move up. This is the place where in the past it has failed. So again, if we see a failure of 142, then all the downside targets remain the same, and it's a channel trade between here and back to the 200 period moving average. So we know how to trade that, but we also need to be prepared for upside moves. Four symbols and where they are with respect to the river. Again, SPY, you can see riding the upper Bollinger Band. Small caps have been lagging, although they did find support at the lower end of the river. You can just see how much weaker small caps have been with respect to S&P. There's a strong correlation, but the large caps are definitely leading the way. They're hugging the upside of the river, and the small caps have been testing the downside. Gold finding support at 150, and again, if we see failure in SPY, then gold is postured to make another significant move. Treasuries just continue to march north as the alternate between SPY and gold. Frog statistics: consumer discretionary, real estate, treasuries, tech. Brazil should be of interest, very volatile, and up in the green, and everything north of 3.0 is favorable. Even Microsoft and Disney are attractive here. Signal to noise ratio, the fail stat for reference. Signal to noise ratio for reference. Holding X days percentages right now, the S&P on a 10-day basis, Z-score of 0.61, on a 5-day 0.96. So that's fully valued. That's been the upper limit of a normal excellent move over the last 5 days, most of that coming on Friday. But still not an exceptional move by any means, because it can go, it's gone as much as 19% up in 5 days, which was a Z-score of 7.3. So room on the upside for the S&P, even on a short-term basis. The 40-day gains of 8.76 actually starting to look like a pretty strong upward move. And remember, a lot of that came on Friday, though, and closed well. Still, we have a decent 40-day holding period. The 20-day at 1.89%, not very impressive at a Z-score of 0.29. And so what this really means is that the market is postured for a long-term successful move up through 142 and beyond. It's supported by all the descriptive statistics. Looking at the relative strength scores, this is normalized regression line slopes. And you can see that the Dow has been the strong play in the large cap conservative companies. But even the small caps and the mid caps and the tech, you can see them coming on. That's a sign of risk on coming. Small caps look very attractive to me because of how much they've been weak over the last 3 months. And they made the biggest relative move compared to the S&P. All the commodities failing. The blend and the oil starting to drop relative to equity, so it looks like equity's on, and even the internationals are coming along, although Japan is lagging the most. Leading the way is EEM. More references, and that's as far as we'll go with the daily today. Thanks for your attention.